Dividend lessons from the Great Depression. Are we headed there again? The Great Depression of the 1930s was a catastrophic economic event that reshaped global economies, financial markets, and investment strategies. Among the many lessons learned during this period, one of the most significant for investors was the importance of dividends. As stock prices plummeted and volatility soared, companies with strong dividend policies provided a beacon of stability and income for beleaguered investors. In today's uncertain economic environment, marked by inflationary pressures, geopolitical tensions, and market volatility, many investors are wondering if we might be heading towards a similar economic downturn. This article aims to explore the dividend lessons from the Great Depression, analyze the current economic landscape, and provide insights on how modern dividend investors can prepare for potential market turbulence. The role of dividends during the Great Depression. During the Great Depression, the stock market lost nearly 90% of its value from its peak in 1929 to the bottom in 1932. Many companies went bankrupt, and those that survived often saw their earnings decimated. However, dividends played a crucial role in providing investors with a steady income stream during this challenging period. Stability in uncertain times. Unlike capital gains, which are dependent on market sentiment and price appreciation, dividends represent a tangible return on investment. During the Great Depression, well-established companies that continued to pay dividends were seen as safer bets. Utilities, consumer staples, and well-managed industrials often maintained or only modestly reduced their dividend payouts, offering investors a measure of stability. Compounding returns. For those who reinvested dividends, the power of compounding became a critical tool for wealth preservation. Even as stock prices fell, reinvested dividends allowed investors to accumulate more shares at lower prices, setting the stage for significant gains when the market eventually recovered. Historical examples of dividend resilience. Several companies stood out during the Great Depression for their ability to maintain or even grow dividends. Companies like Procter & Gamble, Coca-Cola, and General Electric managed their resources well, focusing on operational efficiency and conservative financial management. These companies' dividends became a lifeline for many investors, proving that a strong dividend policy can enhance corporate resilience. Are we headed toward another depression? While predicting economic catastrophes is challenging, there are both parallels and differences between today's economic environment and that of the 1930s. Similarities. High market valuations. Just as in the late 1920s, current market valuations are elevated, leading some analysts to predict a potential correction. Debt levels. Both corporate and consumer debt are at historically high levels, which could exacerbate economic stress if a downturn occurs. Economic uncertainty. Geopolitical tensions, such as those between major economies and conflicts affecting supply chains, echo some of the uncertainties of the pre-depression era. Differences. Monetary policy. Modern central banks have more tools at their disposal, including quantitative easing and a more developed understanding of monetary policy, which could mitigate the depth of a potential downturn. Regulatory safeguards. Financial markets today are more regulated, with mechanisms like circuit breakers to prevent the kind of crash seen in 1929. Dividend strategies for uncertain times. If we are heading toward a recession or even a depression-like scenario, there are several strategies dividend investors can employ to protect their portfolios. Focus on dividend aristocrats. Dividend aristocrats are companies that have consistently increased their dividends for at least 25 years. These companies typically have strong balance sheets, resilient business models, and a commitment to returning value to shareholders. Seek defensive sectors. Sectors like utilities, healthcare, and consumer staples tend to perform better during economic downturns. Many of these companies offer reliable dividends and have businesses that are less sensitive to economic cycles. Evaluate payout ratios. A company's payout ratio indicates how much of its earnings are paid out as dividends. Companies with lower payout ratios have more room to maintain dividends even if earnings decline. Consider dividend growth. In addition to high yield, look for companies with a history of growing dividends. Dividend growth can help protect against inflation and indicates a company's confidence in its future earnings potential. Conclusion. While history does not repeat itself exactly, it often rhymes. The Great Depression taught investors the value of dividends as a source of income and stability. By learning from the past and applying those lessons to today's market conditions, investors can build a resilient dividend portfolio that can weather economic storms and provide long-term financial security. As we navigate these uncertain times, Focusing on quality companies with sustainable dividends, adopting a long-term perspective, and maintaining discipline in portfolio management can help investors not only survive but thrive, regardless of what the future holds.